What is a diversified investment portfolio? So, you want to build a diversified investment portfolio. But what does that even mean? Simply put, a diversified portfolio is a mix of different investments that can help you grow your money over time. Think of it like a garden. You wouldn't plant just one type of seed, because if that seed is affected by pests or weather, your whole garden could be lost. By planting different types of seeds, you reduce the risk of losing everything. Why diversification matters: imagine you put all your money into one stock. If that stock does poorly, you could lose a significant amount of your investment. But if you spread your money across different investments, like stocks, bonds, and real estate, you'll be less affected by any one investment's performance. This is called diversification, and it's a key principle of investing. What are the main types of investments? There are several main types of investments to consider. Asterisk stocks, ownership in companies, like shares in Apple or Google. Asterisk bonds, loans to companies or governments, which earn interest. Asterisk real estate, property, like a house or rental building. Asterisk commodities, physical goods, like gold or oil. Asterisk cash, savings accounts or money market funds. Each type of investment has its own risks and potential returns. We'll explore these in more detail. Understanding risk tolerance before building your portfolio. It's essential to understand your risk tolerance. Do you prefer stable, low-return investments, or are you willing to take on more risk for potentially higher returns? Think of it like a seesaw. As you move to more aggressive investments, the potential reward increases, but so does the risk. Allocating your assets. Now that you know the types of investments and your risk tolerance, it's time to allocate your assets. This means deciding how much of your portfolio to put into each type of investment. A general rule of thumb is to allocate asterisk 40-60% to stocks, asterisk 20-40% to bonds, asterisk 10-20% to real estate, asterisk 5-10% to commodities, asterisk 5-10% to cash. This is just a starting point, and you may need to adjust based on your individual circumstances. Rebalancing your portfolio. As your investments grow or change, your portfolio will become imbalanced. That's when you need to rebalance. This means selling some investments and buying others to maintain your original allocation. Think of it like adjusting the weights on a seesaw to keep everything in balance. Ongoing maintenance. Building a diversified portfolio is just the first step. Ongoing maintenance is crucial to ensure your investments stay aligned with your goals. Set aside time each year to review your portfolio, rebalance as needed, and make adjustments. Recap and next steps. To recap, we've covered asterisk what a diversified portfolio is, asterisk why diversification matters, asterisk the main types of investments, asterisk understanding your risk tolerance, asterisk allocating your assets, asterisk rebalancing your portfolio, asterisk ongoing maintenance. If you're new to investing, don't be discouraged. Take small steps towards building your portfolio and consider consulting with a financial advisor for personalized guidance. Thanks for watching. If you found this video helpful, please subscribe and comment below with any questions.